Hey traders, Jason here from Levitt Brothers. Hope you're well. So in this video, I'm going to talk about a few divergences that have popped up over the last week that suggest we probably need a little bit longer of a consolidation pattern. Overall, the market is doing fairly well. Not really well, but it's doing much better than it was. The index is all printed higher highs. There's definitely been some improvement. This is the best the market has acted since the market topped. But in the near term, we have a bunch of divergences which tell us that the market probably is going to consolidate a little bit further before trying to move up. Okay, before I get started, quick note. We have our Cyber Week special going on right now. If you buy an annual membership, you get 3 months free. It comes out to be about $47 a month. And for that, you get our analysis, daily and weekly reports. You get all of our trading ideas. You get access to our message board, which I spelled message wrong, where we have a lot of really good traders who post ideas and comments and this and that. So in order to do that, you can go to levittbrothers.com. There's a link below this video. Go to levittbrothers.com, click subscribe, buy an annual membership, and we will manually add the extra time on. All right, let's get to this video. All right, so first divergence I want to point out is between the S&P 500 and the NASDAQ. Okay, they like to confirm each other. It doesn't matter which one goes first, but they do like to confirm each other. And when there's not a confirmation, the market tends to have to, just kind of pause and wait till things sort themselves out. So first of note is that the S&P moved up here and came back and obviously put in a very obvious higher low. Whereas the NASDAQ moved up, it was not able to take out its previous high here, unlike the S&P, which did take out its previous high. And then it came back all the way back down and basically tested a low. Other than the open on this day, it basically tested a low. So whereas the S&P, there was a big gap, there was nothing over here. So that was kind of a warning. Both moved to a higher high. Looked like the NASDAQ was finally going to jump on the bandwagon and actually start confirming movement elsewhere. But then it didn't last because the S&P moved down and moved to another higher high here, but the NASDAQ put in a lower high here. So that's one divergence, is that the S&P is trying to push higher, the NASDAQ's not confirming the move. It doesn't mean the market has to fall hard. It just means we're probably going to get a longer consolidation pattern here so that this divergence can work itself out. All right, next one. Okay, this is the S&P 500 up top. And down below is the 5-period moving average of the NYSE AD line, and this is the 10 moving average of the NYSE AD line. Okay, little divergences tend to pinpoint turning points. Turning points don't have to be big reversals; they could just be minor reversals followed by a little consolidation and then a resumption of the trend. So, as an example, you have S&P moving higher there. 5-day moving average of the AD line putting in a lower high, and the market reversed, as you can see. So we have a little bit of one right now. We've had two in a row. So we had a higher high here, lower high here, lower high here, and what happened is the market pulled back and has gone sideways for nearly 2 weeks. We have another one here because the S&P printed a new high late last week, but we still have lower highs here. Now, it's not a strong divergence because these prints are still pretty high, but it is a divergence, and it just tells you that the AD line was something right here, and then when the market printed a higher high, the AD line was a little bit worse off. It doesn't mean it was bad. It just means it just kind of declined a little bit. So it's a little bit of a warning beneath the surface that the advancers did not beat decliners by the same degree. All right, next up is the breadth thrust indicator. What that is the NYSE, and you can see here, I have it written here. It's the advancing volume relative to total volume. Divergences work well here in both directions. I'm going to highlight a bunch of them. This one's hard to see. You got a higher high here, you got a lower high here, and the market reversed. Over here, you had market falling to a lower low. Thrust indicator put in a higher low, and the market popped briefly before coming back down and then actually running up after that. You have market makes a higher high here. We have a slight lower high here. Market pulled back. We have a lower low here, higher low here. Market actually popped off the low. We have basically the same highs here, but the breadth thrust, while that consolidation pattern was taking place, the breadth thrust indicator was falling pretty hard. We have higher high here, same highs here, again reversal, lower low there, higher low here, again reversal. So what we have now is we have like a double divergence. We have higher high there, higher high here, but we have lower high and lower high there. Okay, so again, it doesn't mean the market has to fall hard. Some of these divergences just simply led to like a minor reversal, and then after consolidation, the market righted itself and then continued on. Sometimes they pinpointed bigger turns. So this tells, I mean, this is still a healthy level here. It's pretty good. But it just kind of tells me that until this thing works itself out, we're probably going to get a further consolidation pattern here and perhaps a little bit of a bigger pullback. We'll see. I mean, the bottom of the range here needs to hold. Okay, so it is a minor warning here. Okay, next up we have S&P 500 up top, and we have the percentage of Russell 3000 stocks above their 20-day moving average down below. So essentially when we have another divergence here, we have two of them here, we have lower high there and another lower high there. So essentially what's going on is the market is here, and you have like 83% of stocks above their 20-day moving average. Then the market puts in a higher high in only 80%. Okay, so like there's less stocks participated in this rally, and then you have another higher high, and you have a print here down near like 70, 71, 72%. So each successive move up had less and less stocks participating. So it's a little bit of a warning. It tells us that internally the market is weakening. Okay, same thing, but instead of with the 20-day moving average, we now are using the 50-day moving average. Okay, market does this. We have this many stocks at above their 50-day moving average. Market makes a higher high. This time we have even more, so that supports the uptrend. Market makes another high over here, but this time we have less stocks. Okay, it's about the same. So is it a major divergence? No, not a major divergence, but when you compare it to this, where the market was going up and you had steady improvement here, it's notable that we have basically the same prints here as the market continues to press higher. Okay, so a little bit less, fewer stocks participating on the most recent run up tells us we probably need a little bit longer resting period to digest the gains. Okay, next one, this is the S&P 500 up top versus the Russell 3000 1-month high low. Okay, so it's like how many stocks within the Russell 3000 are making a 1-month high versus the number of stocks making a 1-month low. Divergences work fairly well here. So what you have here is you have markets here, and you have about a little bit more than 1,000 stocks made new highs versus new lows. Then the market does a higher high, and you pretty much match that number. And then the market makes a higher high, and the number drastically falls off. Okay, and right now we're like basically rated 0. So even though the market is close to a multi-month high, and it's pretty far off its low. This is 3,600. This is up near 4,000. Even though it's done that much, you have basically equal number of stocks making a 1-month high as a 1-month low. So that tells you internally the market is weakening, less stocks are participating. Okay, next one is same thing, except we're doing 3-month highs. Okay, so it's a little bit harder for stocks to make a 3-month high, but it's a bar that we would like to look at. So we have the same divergence forming with the market making a higher high, less stocks at a 3-month high versus a 3-month low. So it just tells you beneath the surface, less stocks are participating. Okay, so the sum of all this is market's doing fairly well. It's fine. It's been stair-stepping up. All the indexes printed higher highs, within the last, recently that go back like 2 months. But we're starting to see some divergences, which tell us that participation rate is declining. So we got to watch out for that. We're probably going to have a little bit longer consolidation pattern before the market tries to leg up. Even if if it's going to try and leg up, we don't really know. We just know that in the right now, in the here and now, we're probably going to have a little bit more of a resting period before any type of rally attempt materializes. All right, that's all I have. Remember our Cyber Week special, buy an annual membership, get 3 months free. Great deal. Take us up on it. We only do this once a year. All right, good luck, and I will see you next time.